Good afternoon, ladies and gentlemen. Welcome to the Balanced Commercial Property Trust investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Please just simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and as usual, we'd be most grateful for your participation. I'd now like to hand over to Christine Cantrell, Director and Head of Investment Trusts.
Thanks very much. Yes, I'm leading the sales and distribution of the range of investment trusts at Columbia Threadneedle. So we're one of the leading investment trust providers, and actually, as asset managers go in the UK, we're now one of the top 10 by assets under management following the acquisition of BMO Global Asset Management. So now all the branding has changed, as you'll see through Richard's presentation. We are now officially Columbia Threadneedle Investments, and Balanced Commercial Property Trust, which is the new name of what was previously called BMO Commercial Property Trust, is one of the largest in our stable. And Richard Kirby is the fund manager, and we really want to take this opportunity to hear from you as well. So following Richard's presentation, we'd like to go through as many of your questions as possible. So please do enter them as you listen to Richard. So thanks very much, and I'll hand over to Richard now.
Thank you, Christine, and good afternoon, everyone. I'd like to take this opportunity to take you through an updated financials and our outlook for the Balanced Commercial Property Trust. So there's a little bio on me here. I've been with the group for over 30 years, and I've been the lead manager on BCPT since the listing in 2005. I have some executive responsibilities within Columbia Threadneedle, but the only investment management role I have is on BCPT. So I'd like to take the next 20 minutes or so to take you through the headline annual report numbers, look at the property market overview, and then really turn our attentions to BCPT and run through some key information, performance, latest transactional activity, some of the key drivers of portfolio activity and performance. Then look at the company's largest asset, which is the St Christopher's Place estate in London, and then pick up some of ESG initiatives and key priorities. So 2021 was a strong year for the company. We achieved a share price return of 37.8% and NAV per share total return of 18.9%. The March NAV was 144 pence, and that was up 6.6% since the year end. And within the next week, we will be releasing our June NAV to the market. This next slide just picks up on the performance of direct and listed real estate over 1, 3, and 5 and 10 year periods. And you can see from these slides that both the listed real estate sector and the direct sector have performed well over these time periods. Obviously, I'm very aware that over the last couple of quarters, the share price returns on REITs has come off. Moving forward, this slide here picks out the monthly returns on the MSCI quarterly index, and you can see here that the 3-month returns to March 2022 was 4.8%. That was below the outstanding quarter 4 of last year, but still one of the highest quarterly returns achieved on the index. It looks like the outcome for the June valuations will also be positive. And as I say, those will be released probably within the next week and a half. This slide here disaggregates the total return by segments. And here you can see the 12-month return, the 12-month returns from the various segments. And that is split down into income return and the yield impacts. And pretty unsurprisingly, the message here is that industrials and logistic units continue to be the standout segment within the market, strongly supported by retail warehousing, which have had a real renaissance over the last 12 months or so. But the polarization of performance here is really marked between the weaker sectors like shopping centres and those industrial sectors. And we saw that within our portfolio over the first quarter. So in the first quarter, our valuations were up 5.4%, and retail warehouses were up 16.7%, and industrials were up 12.1% over the quarter. This chart really just looks at the comparisons between real estate and the other investment classes. And really, the only thing I'd really like to say to this is that the income return to property is extremely important. It makes up a significant proportion of its total return. And I think as we move into a likely slowdown with higher inflation and the outlook for interest rates, that income return will become a more important component of total return and an attractive to investors in moving forward. So turning now to the Balanced Commercial Property Trust. Some key information here. The objective of the fund is to provide shareholders with an attractive level of income, together with the potential for capital and rental growth, investing in a diversified UK commercial portfolio. It was launched in 2005. As I said, the last NAV per share is 144 pence. We're currently trading as of last night at a share price at 111 pence. And our discount has widened out to just under 23% now, as the markets have been taking a bit of a pounding in the last month or so. The company importantly pays a monthly dividend. I know that's attractive to many of our shareholders, and the current dividend equates to 4.8 pence per annum. So the company is invested in a balanced UK portfolio. We have 34 assets, the main asset classes. We acquire in institutional and sustainable locations, and we have an average lease length of 5.3 years. Our portfolio void at the moment is 6.4%. That has jumped up from the void rate at the beginning of the year, which closed out at a historic level of 2%. That's due to a large office building in Uxbridge becoming vacant in the first quarter. BCPT is conservatively geared. We have long-term borrowings from Legal & General, which are due to be refinanced in 2024. Our net gearing at the end of March with that and the facility from Barclays was 15.7%. And the current drawdown borrowings amount to 310 million at a average weighted interest rate of 3.3%. We've got about 113 million cash as at the end of March, and an undrawn revolving credit facility of 50 million from Barclays. There's been some changes to the board over the last 12 months or so. Long-standing chairman Martin Moore retired last year. Paul Marcuse was appointed as chairman, and Hugh Scott Barrett was appointed as the SID at the beginning of the year. We I have also been embarking on a share buyback program as these persistent discounts are being maintained, and currently we've bought back 83.48 million shares. This slide's now unfortunately a little bit historic. This was the share price and discount as of the beginning of June, and as I've just said, we have seen a share price come off somewhat and the discount widen out from where it was here to around about 23%. The performance of the company last year, the portfolio return. So this is the ungeared return from the direct property assets within the portfolio. Our 1 year return was 15.5% against the benchmark of 16.3%. We had a good first quarter this year, as I highlighted with the capital value movements in the industrial and the retail warehouse sectors, and we recorded a return of 6.2% against a benchmark of 4.7% over the first quarter. And we've got a solid track record of longer term performance and outperforming over the 10-year time horizon. I think if many of you have joined my previous presentations and updates, there has been very much a focus on rent collection since the beginning of the pandemic. I would say that our collection over the period compares favorably to peers. And what you can see from this chart is that pretty much our overall collection rates are pretty much back to the pre-pandemic levels, with extremely strong collection from the industrial and the office sectors, retail being a little bit slower to recover as one would expect, and primarily that's driven by the challenges that St Christopher's Place estate in central London has faced. But you see from these stats that the rent collection numbers on St Christopher's Place are also recovering over the period. So I would say that rent collection is no longer the worry that it was in quarter one, quarter two, quarter three, 2020. It's now not the main metric of performance, and we're pretty much back to pre-pandemic levels. Of our buildings, this chart here highlights the location of our buildings. We're well diversified throughout the UK, with a bias towards London and the southeast, and that's primarily again driven by the conviction holding of St Christopher's Place. Our sector and regional breakdowns are shown in this chart. So you can again see that we have a good exposure across all the property subsectors. One of the big plays that we have been investing in the last 12 to 18 months is the industrial sector. At the beginning of 2021, exposure to industrials was around about 19%. By the year end, that had increased to just over 30%. We have a good exposure to the other sectors as well. We have comprising 10% of the portfolio. We have holdings in Winchester let to student accommodation, and then we have leisure and some alternative uses at St Christopher's Place and Wimbledon. We're well diversified across the UK regions as well, with no exposure to perhaps some of the underperforming geographic regions in the UK. So as I said previously, we hold 34 properties. By far the largest is St Christopher's Place. The next two are our retail warehouses in Solihull and Newbury, and then a variety of properties, Chorley, sort of logistics unit, Winchester student accommodation, Wimbledon, which is mixed use, retail, leisure, food and beverage, and then the next few properties in the top 10. They're all logistics and distribution units. Top 10 tenants are highlighted here in this chart, and you can see there's a reasonable diversification across the tenant roster within BCPT. The void rate, as I previously articulated, has increased to 6.4% by ERV, and you can see in this chart here that's attributable to Uxbridge, which is a large office building, which we are currently looking at the options for, and that potentially could include repurposing of that building to other uses. Last year, we made a number of significant sales. We completed 3 sales, raising gross proceeds of 199.5 million and realizing significant gains compared to the 31st of December 2020 valuations. So the most significant building we sold last year was actually the company's second largest holding, which is Cassini House in St James's Street. So a prime multi-let freehold office building. We sold that in September. Why did we sell that? Principally because we had completed our asset management plans on that building. We had completely refurbished the holding. We'd renegotiated leases with the likes of Artemis and let the other refurbished space within the property, all at rents in excess of £105 a square foot. So we sold that for a price of 145.5 million, which reflected an initial yield of 3.23%. And was just under 11.5% premium to its last valuation. We also sold 2 retail assets, what I think are 2 of weaker retail assets. The first one there is in East Kilbride, Scotland, which is a very large B&Q warehouse. We sold for 19 million, which was a 7.2% premium to its last valuation. And the third asset was in Rochdale, Dane Street, which is a Asda supermarket and adjoining Currys supermarket, which we sold for £35 million. And again, that achieved a price which was in excess of 90% compared to its last valuation. So those were 3 significant sales for the company. What did we do with the cash? Well, we've so far to date spent 66 million. Our first acquisition there at the back end of December last year was in Markham Vale. 2 new logistics units of 220,000 square feet and 76,000 square feet, located adjacent to the M1. We purchased this for 44.5 million. Why did we like this? Well, it's new build. It completed in May 2021. It's well let to 2 good covenants. It's a good location. It's a location which also has a deep pool of available labour, which is becoming more and more important for the users of these types of buildings. It has strong ESG credentials and the RPI linkage on 73% of the income. We paid 3.71%, which when you break back into a capital value per square foot equates to £148, and we think that is low given current build cost inflation, and should be a reasonable platform for growth moving forward. And in fact, there, as you can see, the latest valuation is in excess of our purchase price. Our second acquisition was in Burton-upon-Trent, and this is a forward funding. It's a development, 172,000 square feet, which we'll be completing in the next couple of weeks. This unit was pre-let to Werner UK Sales and Distribution, which is a specialist ladder manufacturer. We paid £21.5 million for this, which reflected an initial yield of 4.84%. And I think that is attractive pricing. Why did we buy this? One, because it's brand new. Its rent was light. We believe the ERV is higher than the pre-let agreement. Again, it's a good location, strong ESG credentials. It's targeting a BREEAM excellent rating. It's an attractive and liquid lot size, and again has RPI linkage. So that was the activity in the capital markets last year. What drove performance within the portfolio? Well, there were some key management successes, which we highlight on this slide. These are all in the industrial and logistics sector, and they vary from re-gearing and renewing leases with Kimberly-Clark in Chorley, which increased valuation in excess of 44%. DHL renewed their lease in Liverpool, which saw a material valuation lift. We worked with Mothercare at Daventry. Mothercare went into administration back in, I think, 2019, but the company that we had contracted on the lease did not go into administration, so they honoured their parent company guarantee there. They paid the rent. There was never any shortfall in rent, and we worked with the tenant there to assign the lease to another occupier, which contracted last year, and we now have Seva Logistics as our tenant, and the re-rating of our counterparty on that lease, if you like, saw a significant value of over 50% during the course of the year. In Liverpool, again, we let 47,000 square foot to Cocoon Rugs on a 15-year lease, and again that drove a valuation increase. We've also, in the last quarter or so, committed to some CapEx projects. These are capital projects that we put on hold during the course of the pandemic. We've now got the confidence to commit and to start those developments. So we're on site developing 52,000 square feet in Speke, Liverpool, adjacent to Hurricane 47 on the previous slide. And we expect the return on cost there to be around about 6.5% when that development's completed. And then in Colchester, we've commenced the development of some rather secondary, tertiary old industrial units. That's due to complete very, very shortly, and then we will commence the redevelopment of a 35,000 square foot trade centre. The capex there will be in the order of about £5.7 million. Retail warehouses, we had some significant successes within our retail warehouse sector. At Newbury, we basically took back leases to stores that were previously let to New Look and Next, totaling 20,000 square foot. We amalgamated those units, and we relet to Home Bargains on a new 20-year lease at a new rent. And this is all part of repositioning these assets to a tenant roster which is more aligned to grocery, convenience and discount retailers, and I firmly believe that's where the future for this type of asset is. And since Home Bargains opened, we've seen footfall on the park significantly increase, and it's now back to pre-pandemic levels. At Solihull, we completed the redevelopment of a new M&S general merchandise store, an amalgamation with the adjoining food hall. So this is a new flagship store. It opened in June last year. It's a new lease at a significant level of rent, and it's been trading extremely well. Again, footfall has increased significantly on the park, and we saw a valuation uplift of over 26% during the course of last year. The flagship within the portfolio, St Christopher's Place, and I must say that St Christopher's Place is it's not all about retail. It is a true mixed-use asset, and you can see on this slide the breakdown of the value attributable to the other uses. So we have retail, food and beverage, retail on Oxford Street, offices, and residential. I think it's fair to say that during the course of the pandemic, this was the most challenging asset within the portfolio. All of its attributes basically became negatives overnight, being its central London location, being retail, being food and beverage exposure, the residential exposure, the reliance upon office workers, tourists, and public transport, all reared its head, and it became a very, very challenging environment for the estate. But we have been leasing new units there. We have entered into a significant number of lease renewals and re-gears, and we've also signed up some fantastic new operators like San Carlo Group, Sidechick, and the others that we've highlighted there. So the footfall on the estate is also recovering incrementally week on week. It is improving. The Q4 2021 numbers, as highlighted here, were strong, and we pretty much reached the levels seen in 2019. For obvious reasons, we don't use 2020 or 2021 as comparatives. So what are we going to be doing on the estate? Well, our strategic objectives there are pretty much to promote the intermix of food and beverage uses with existing shops. So very much curating the estate and introducing more restaurants, more food and beverage operations onto the estate. We've got some exciting ideas for G's Court and Southern James Street. We're looking to engage with Westminster on the Oxford Street recovery. That's really, really important for St Christopher's Place. We own two units on Oxford Street. Obviously, the Elizabeth line opened a few weeks ago, but we have not seen the benefit of that yet because the Bond Street station did not open. And I think that's due to open in September this year. So that should really be enhancing the visitor numbers and the footfall traffic adjoining the estate. This graphic of the estate really highlights some of the activities that we're doing, where we're wanting to create new restaurant, new food and beverage offerings in amongst our retail exposures there. So it's talking to the curating of the estate and repositioning towards more food and beverage. And this is some of the other initiatives that we've got. We've got a number of capital projects on the estate. We want to re-engage with Westminster City Council. Obviously, there was a change in administration there to Labour a few weeks ago, so we've got to build up those relationships. There are a significant number of capital projects that we're reviewing and we will be committing to. And together with our wider ESG ambitions, there's a significant amount of work to be done on our ESG agenda at St Christopher's Place. Now, moving to ESG, obviously phenomenally important for the company. What have we been doing? Well, the board has recently set up a formal ESG committee. So I think that resonates with how important they believe ESG is moving forward. As a company, we provide an annual ESG report, which describes all our strategy, our priorities, and key achievements, and includes a lot of granular information on measurement, and that is available on the company's website. Our highlights this year was we continued to submit to the GRESB survey, and we have internal targets to achieve year-on-year improvements there, and we achieved a 10% improvement on our previous score there. We issued a net zero carbon pathway, committing to a target of 2040 or sooner. We continue to receive gold awards for our reporting from EPRA and disclosure. Often the S in ESG is overlooked, and one of the initiatives that we were able to achieve last year was the formal accreditation from the Living Wage Foundation for adopting living wages for in-scope suppliers. So what that means is really the suppliers that we employ in managing the service charges. All of those contracts have been renewed with living wage commitments from those suppliers. So to summarize, when breaking down activity, I think income and growth, we've experienced strong rental collection, which has enabled increases in the dividend. And as I said, when I talked to the slide, rent collection is now stabilized at pre-pandemic levels, and our ambitions are to grow income and dividend as we move on. There's a heck of a lot of asset management within the portfolio. Some of that was put on hold during the pandemic. We're now committing to that, to those capital projects, and that's a significant number of opportunities to extract value and drive capital growth. We're recycling capital. You've seen that from our sales and acquisitions last year. We have stood back from the market over the last 6 or 7 weeks because we have felt that the market got somewhat overheated, especially in the industrial and logistics sector. And we are seeing now some price movements, some price corrections, and a reduction in competition for a number of opportunities. So moving forward, I think dislocation in the markets creates opportunities, and it's down to us as experienced fund managers and investment managers to exploit those opportunities and be really, really robust on our stock picking, and to be fundamentally moving forward. When our activity in the capital markets is going to be reliant upon picking the right assets, the sustainable assets, and those assets which will create income and capital growth moving forwards. And then we continue with our share buyback program, and we continue to utilize proceeds from sales to buy back the company's shares where that discount is persisting. So I think really from my perspective, I've run over time, and I hope that's given you a somewhat detailed overview of the Balanced Commercial Property Trust and the activity and the progress we're making with regard to the portfolio.
That's great, Richard. Thank you very much indeed, and certainly not over time by any means. So thank you for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab just on the right-hand corner of your screen. But while Richard takes a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Christine, maybe a good time for me to hand back to you, if I may. You can see investors have submitted a number of questions. If I could ask you, perhaps, if I may, to read out those questions for Richard to respond where it's appropriate to do so.
Yeah, perfect. Thank you so much. So the one that was pre-submitted, I think, is very broad. So I'll just start with that one. And you have alluded to some of the points already, so hopefully it's not too much repetition. But there were a number of questions about the discount, and this one is trying to get to the bottom of that. It's asked, what actions are you taking to close the discount against the NAV?
Okay, well, so at portfolio level, I think we were trading at a discount before the pandemic kicked in, and that was due to our exposure to retail assets. And I think retail assets became quite toxic, and certainly some investors and shareholders could not see through the quality of assets. So I think we've obviously sold two of our weaker assets. We've been investing with regard to stronger assets in rebasing that tenant lineup and offering, as I articulated against those two slides. And you've seen the recovery back in the capital markets and the strong returns from the retail warehouse sector, which we've benefited from. St Christopher's Place, there's still some work to be done there to get that up to pre-pandemic levels, but you've seen the rent collection numbers, and I've talked you through the strategy we have for the estate. I mean, that is prime central London, a landed estate, and that will recover, and our business plans are being executed there. So, and at the portfolio level, we increased our exposure to industrials, as I said, from 19% at the beginning of 2021 to over 30% by year end. And that will continue to increase as we're investing in the portfolio, and we have some other acquisitions highlighted. So that's what we're doing at the portfolio level. Obviously, the board is continuing in its share buyback program. We've now bought back in excess of 80 million shares. And then there's all the softer side that we're doing in making ourselves available to shareholders, in increasing our marketing. My appearance on this platform in order to articulate what we're doing is fantastic. I don't know if you want to add anything more, Christine.
I would actually just tag on about when you're referring to both the portfolio investment side that you can do and also share buybacks. Michael has asked, in your view, which is better? But you probably would say it isn't an either or. But could you comment on that at all?
I think it's not an either or. I mean, it depends obviously on the discount, the level of discount, and the opportunities within the existing portfolio with regard to development and asset management, and also opportunities that we're seeing in the market. We've done a lot of modelling on that. There is, given our property outlook, there is a level at which share buybacks don't look so attractive against reinvesting in our own portfolio, but I'm not sure that I can disclose that number.
That's fair. And maybe just to add my comment in terms of the discount, obviously, from my perspective, being part of a broader team now at Columbia Threadneedle, we are speaking to different types of investors, a wider variety of them. So I hope that then the future is rosy in that perspective, because we're just being faced with better opportunities to get more shareholders on board, which then ultimately tightens the discount. Then a question more on the portfolio. We can move to Simon's question. What is your ideal sector weighting within the portfolio? And given the slowdown / inflation, etc., what is your outlook for the property market over the next year?
Okay, so we've already seen a slowdown in certain sectors, and I think I began to talk to that within my presentation. Certainly within the industrial logistics sector, we've seen the strength and depth of underbidders decline in that over recent weeks, and there has been some price adjustment. So we are looking at that market as an opportunity. I think there will be a slowdown. I think the rental growth, the very high levels of rental growth that are being forecast 3 to 6 months from that sector will have been reduced. But I would say that the rental growth forecasts from the industrial and logistics sector relative to other property segments still looks attractive. So we are still focusing acquisitions within that sector, but being very, very robust, very much relying upon our experience and stock picking. And we are seeing more opportunities, Christine. So we've been actively bidding on assets over the last couple of weeks, because we're not encountering the massive amount of competition that we were 6 or 7 weeks ago. So I take this as an opportunity to be acquiring good quality stock without the aggressive competition. But with industrial logistics, we would perhaps have a target sector exposure there of around just under 40%. We've got some other sales that we've highlighted within the portfolio that we want to undertake this over the next 12 to 18 months. So there's going to be a continued recycling of capital. I think with a movement into, as I say, industrial logistics, and we're also focusing on the alternative sector. Outlook for the property market over the next 12 months. I think we are obviously in a high inflation environment. The outlook for interest rates is for those to increase. So I think certain stock will come under pressure. Certain valuations will fall. There will be some price correction there. I think in this sort of environment, it's all about investing in prime property.
Thanks. And just on that, because I've also had another question from Dave, in terms of the robustness of the portfolio, if the slowdown becomes a bit more severe, such as a recession or more severe economic conditions, how do you see the portfolio faring?
I think that I think that the portfolio is set fair. I think we've got a fairly robust tenant base. I think I saw a question about the average lease length being 5.3 years, and does that concern me? I think we're just generally seeing lease terms outside certain specialists and alternative sectors reduce. Definitely at St Christopher's Place, where we've got 100 140, 150 tenants, very much written on shorter leases, and we get the tenant churn there. That doesn't concern me if we can let those units. And we've demonstrated during the pandemic the pandemic that we can let properties. And as I say, we finished last year at a historic low void rate of 2%. We've got this increase now to 6%, which is due to a building that we pretty much knew was coming back to us, and it's about reinvesting in that and repurposing that and getting that relet or sold. So I think the tenant base is and the buildings within the portfolio, we've proven over periods of time that we can relet and secure income on these properties.
Yep, exactly. That's really helpful. Maybe now just a few of the technical questions. Kiri is asking, what does IY stand for? I think it's initial yield. I think it's referring to one of the purchase prices. Am I correct there?
Yeah. So IY.
Yeah.
So that's an initial yield, and I think I talked to that on when I was talking to the capital market. So, for instance, like Burton upon Trent, which we acquired off an initial yield of 4.84%. So that reflects the rent contracted divided by the agreed purchase price plus the costs, so the stamp duty, legal costs, and agents' fees. So it's the contracted income divided by the gross purchase costs.
Perfect. And then in relation to that Burton upon Trent property, just could you comment a bit more about the valuation of that since you bought it?
I suppose I haven't portrayed that in the best light because the valuation is below the contracted price on that development. But this is a forward funding, so every month we pay what the developer is spending on that building plus professional fees. So incrementally every month the valuation will increase by our capex spend and any yield movement. So hidden in those numbers, obviously, we haven't paid the full amount for the building yet because it's not complete, but the underlying yield has seen yield compression since we bought it. So in August, then we'll be paying the last outstanding amounts to the developer for the construction, and then there's a balancing payment to the developer, which is effectively his profit, and you'll see those sums go through in August.
Okay, thanks for explaining that. Now, we alluded to it before about the change in name, but David is specifically asking, can you give more detail on the change from BMO Commercial Property Trust and the necessity to change, as well as any change in the style or investment direction, if any, that will be targeted as a result of the change?
So picking up on the latter parts of those questions, then there's no change in style, in investment process, in strategy. That's all been agreed and is regularly reviewed by the board. Yes, there was a necessity to change the name because BMO was acquired by Columbia Threadneedle, and as part of that sale and purchase agreement, there was the requirement to move away from BMO, and that had to be achieved by last week, wasn't it, Christine? 4th of July, I think.
Yeah.
So yes, it was necessary. And the board reviewed all options and decided to go down an independent name, Balanced Commercial Property Trust, which also enabled us to retain our stock exchange ticker. Is there anything you'd like to add, Christine, to that?
No, I think you covered everything. and it actually has been just a very smooth transition, mainly because the code is the same on the stock exchange, but equally there is just such a big following, and we've communicated it really well about the change in name. Hopefully, at least that's what it seems like so far. So yeah, we'll make sure we're on it going forward and make sure everything is updated where it needs to be. But that's actually all.
That's great. Christine, Richard, thank you very much indeed for taking investor questions this afternoon, and thank you to all those investors that took the time to submit their questions. If any further questions do come through, we'll obviously make those available to the company. Richard, I know that investor feedback will be particularly important to you and to the company. Before I redirect investors to give you their thoughts and expectations, I wondered if I may just ask you for a few closing comments just to wrap up with, after which, of course, I'll redirect investors to give you their feedback.
Certainly, but just my closing comments would be, a strong 2021. We've started this year strongly as well. I think the markets are beginning to soften. We're beginning to see some dislocation. I would say moving forward, the portfolio is well positioned, should be relatively defensive, and given that we're seeing some dislocation in the capital markets, that's an opportunity for me as a stock picker to take advantage of that and hopefully exploit some good opportunities for the company moving forward.
That's great. Richard, Christine, thank you once again for updating investors this afternoon. Can I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Balance Commercial Property Trust, I'd like to thank you for attending this afternoon's presentation. That now concludes today's session, and may I wish you all a very pleasant afternoon. Thank you.